Yeah, well, I thought that was a terrific presentation by Michael. I'm really glad that we got a chance to sit in and hear that. I think we're going to continue some of that discussion during this panel. Um, we might have a little different viewpoints from what he presented, and so that'll be fun for a little give and take. So thank you very much, Marty, for this opportunity. Good morning to everyone in Los Angeles. It's afternoon here in Philadelphia, although I got New York in the background. Joining me this morning for a discussion on Alternative Alpha Strategies 2023 are Ron Davari, Executive Chairman and Chief Investment Officer, co-founder at NewOak, an advisory asset manager and a fintech firm. And he's got a great story to tell. You're going to love hearing it. We're also joined by Cory Reeder, a Chief Investment Officer for an asset manager. We've had Cory on before, and we've had some great discussions with him. He always comes up with some great one-liners like the mother of all bubbles and things of that line. So I'm excited to hear what he'll leak out for us today. And finally, we had Tyson Halsey, managing member of Income Growth Advisors. Tyson and I have worked together as well before in the past. He always has some great insights. I think he'll be bringing some thoughts to this, particularly around gold, that you'll be interested in hearing. So I'm looking forward to this discussion. It's going to be lively. It's going to be energetic. It's going to be electric. So let's get ready for that. We're going to talk about a bunch of topics related to alpha strategies, including what is an alpha strategy, identifying alpha strategies for the foreseeable future, the sustainability of alpha strategies, the concept of beta and how that relates. So we're going to get into all that, but let's get some intros out of the way. I'll start with myself. My name is Mark Heil. I've been involved in alternatives since the mid-90s in marketing, capital raising, and fund administration, helping investors to tap into the alternatives using retirement funds as well. So I've seen the business from many different angles and have a few perspectives to share. To be clear, this panel discussion is for educational purposes only and not to be considered tax, legal, or financial advice. To the extent I offer an opinion, it's my opinion alone and not of that of any association or affiliation I may have. For the next hour or so, we're going to have this great discussion, debate around the topic of alpha strategies. I invite you to be part of it. And when you ask your questions, though, I ask for questions that are concise and to the point, as opposed to speeches that then become a question at the end. So invite you to join in, and it doesn't have to be a question. It can be a comment or a thought, or you might want to ask them, our speakers about something. Feel free. I want to get you involved. We're really fortunate to have a talented group here with me today. And Ron, I'd like to just start with you and maybe have you take 2 or 3 minutes, talk about yourself and talk about NewOak and what you're doing there. I think it's fascinating.
Oh, thanks so much. And good morning to all and good afternoon to whoever is in New York side. Again, thank you, Marty, for having us. Thank you, Mark, for really putting this together, and it's going to be a great panel. My story in short, went from engineering to financial engineering, headed BlackRock's essentially structured finance globally, and but decided that really in 2008 it was time to go upstream and go into what I consider finance assisted by technology, and try to effectively repeat what BlackRock had done in public assets or securities that are traded on the screen, to be able to bring that sort of transparency as well as accessibility to the private assets, starting from debt instruments that are backed by all sorts of different assets, and really create an alternative platform to the securitization as we know it. And it took a long time to get the Web 2 version sort of set up and get going and really originate, underwrite, due diligence, package, and offer, and then manage. So those of us who have been in that process, they know that will leave a lot of people behind and a lot of time, and a lot of effort. And recently, in 2016, we decided to really go into real finance. So we set up NewOak Finance, assisted by technology. That's future pay, Orbis pay, which would end up being essentially, we'll describe that, is an ecosystem to effectively get embedded finance and be able to transact and then follow that transaction into vehicles that investors can participate in. And very recently, as early as last 3 weeks, we have essentially embarked on the bridge between Web 2 to Web 3 to effectively make that process even further accessible to the to both institutional and individuals. I'll leave it at that.
No, that's terrific. And we're going to dive into a lot more of that a little bit later. So, Cory, I want to move the football over to you, or should I say hand the basketball to you? I don't know what the proper terminology. I guess I'm playing point.
Or you can pitch it to him.
Maybe. By the way, Ron, I want to know what your drink of choice is on that beach.
Oh, this is not a real beach, it's a background. I'm heading to Bahrain and Abu Dhabi and Dubai, so I thought I will prompt you guys with that.
Make us all envious. Enjoy.
Take his money.
Yeah, so hey everyone, Cory Reader. For those of you who have not seen me before, heard my spiel, to Mark's reference, you can't see it here on Zoom, but I am 7 feet tall, and I played basketball professionally for 9 years in a former life. So I always call Zoom the great equalizer because we're all 7 feet tall on here. So I moved over in the financial services arena in 2005. Stepped out of the broker-dealer world in 2017 and started to expand my areas of expertise and along with my partners. So I've been running some funds at a wealth management firm previously. That is now changed out. I've moved over more to, I guess in essence, institutional side. I'm not working directly with individual investors, but if anyone likes, what they hear or what we're doing, then I can put you in touch with the right people for either yourselves or for your clients, if there are applications there. There's someone else you talk to. But we also have another new venture, which is an expansion of what we've been doing since 2017. And I saw Mike had mentioned in the chat area, mentioning PPLI. So we are bringing the largest issuer of private placement life insurance from Europe and expanding them into the US. It's about a week and a half from now, we should have the official announcements. I'm not going to share any names or anything, but this is something I've been evolving into since 2017. But anyway, so just here to share our thoughts. And I guess, Mark, I'll cut it there. And then after Tyson does his little presentation, I'll bring up my slides after his.
Sounds good. Tyson, you're on. Why don't you give us a little bit about yourself, and then you can dive into your presentation. Marty, I assume you set up the screen sharing?
Yes.
Beautiful. You're the man. Thank you.
Okay. Can you all hear me?
We
And
can.
you see me, so it's working. I got a little cowlick there. I'm Tyson Halsey. I'm an investment advisor. I'm the founder of Income Growth Advisors. I've been in the business for almost 40 years. And what I'm going to do on this panel, I'm going to just skip the intro part and just get to it. Can you all see the presentation? It says Alternative Alpha Strategies.
We see it.
Okay, so I'm going to quickly go over a capital market overview. I'd say that the greatest book I ever read on finance is Robert Shiller's Irrational Exuberance. And one of the things he brought into perspective is markets in perspective over, long periods of time and their valuation, but also the psychological factors. And you'll see some of that in how I present this. So I'm going to talk about the capital markets. I'm going to talk about gold and why I think that is a superior alpha strategy in the alternative space. And sometimes people don't know what alpha and alternatives mean. Alpha is your outperformance relative to a benchmark. And alternative basically means it is not a stock, bond, or cash. So actually real estate, private equity, venture, but maybe everyone knows that, but just to be safe. So let's see here. Wow. Okay, so I think that the most critical big picture item to look at all the markets and asset valuations is that for 40 years we had declining interest rates. From 1981 till 2020, we had interest rates on the 10-year US Treasury go from 15.5% to 0.5%. And as it relates to stocks, bonds, and real estate, they all generate cash flows, incomes. And consequently, anybody who knows anything about financial valuation is you want to look at the present value or the discounted value of those cash flows, and they all tie to interest rates. So the very fact that we are no longer in a declining interest rate environment is going to change the inherent bias on all asset classes. So my general view here is that, you know, the bond bull market that drove stocks, bonds, and real estate, it's over. It's just not going to be as easy. And one of the things that I think is going on is we have entered a commodity cycle. And a way to look at that is looking at the Commodity Research Bureau Index ratio to the S&P. And you all may remember from 1999 to 2011, you had oil take off. It went from 20 to 170, and gold also went up about sixfold. But the stock market crashed. It had two declines, 2000, 2008. We got a bottom in the S&P in 2009 in March, and then went from 666 to about 4,000 more recently, where it is now. But now you're starting to see the commodities come back. And I think that equities are putting in a major top. And this is all consistent with an inflationary environment. And anybody who can read and isn't deaf knows that we've been dealing with inflation and a real problem with that over the last few years. Another way to look at it and support the idea that we are in a cycle is here, this is kind of Schiller-esque. You look at the 140-year history of stocks relative to commodities. And everyone knows commodities did great in the 1970s, oil took off, but so did gold. And frankly, equities were a terrible place to be, but then things reversed from in the 80s and the 90s. You wanted to be in stocks, forget commodities. But then again, that flipped again for an inflationary period from 2000 to 2010. And then after you had big runs in oil and commodities and the stock market had consolidated, we had a period of deflation. You had lower and lower interest rates, stocks took off. It was great. We think that that trend has flipped. We definitely have inflation. And but with regard to what kind of price performance that you could see in terms of gold as a particular asset, it's good to look at the history. And most people may not be that familiar. So in 1970, gold was fixed, $35 an ounce. It went up almost 20-fold to almost $700 by January of 1980. Now, that's not a fair representation of the type of return it was, but that was a massive return. And the problem was it was fixed before that. Then you had, during a period of the 80s and the 90s, when stocks did well, gold went sideways, actually it went down. So you had a pullback over 2 decades. As soon as the stock market peaked, gold started to take off again. It went up sixfold between 2000 to 2011. And then again, you had this cycle switch, and then basically gold has been going sideways since then. What is attractive for gold, and I'm talking about both the metal as well as the stocks, is it's non-correlated, it's gaining momentum. Historically, it's an inflation hedge, but relative to all other commodities right now, central banks are buying it. And they're actually buying it in scale, or you're seeing a real meaningful pickup. The last half of 2020 saw the greatest purchases by central banks of gold in 50 years. Now, it's also worth keeping in mind the size of stocks, bonds, and real estate. And the equity markets and the fixed income markets are about 125 trillion, a couple years old, but I'm trying to just give a sense of scale relative to 11 trillion for the gold market. And frankly, if you were to throw in real estate, because frankly, that's a major asset, I suspect it's larger than both either stocks or bonds, but you're probably looking about 400 trillion. And that amount of money is not going to see the attraction and the performance that it has for the last 40 years. And so money is going to go into alternative assets. And I think that gold is a very logical one. And when we talk about gold, there's gold the metal, but there's also gold the stock. I'm just going to highlight a couple of the facts about gold, the stocks, that I think make them particularly compelling. They're near historically high cash flow levels. They're buying back their stocks. They have some of the highest dividends they've ever had in their history. They're very strong cash on their balance sheet, low PEs. The mining industry itself, as a percentage of the S&P 500, is very low. And this is reminiscent actually of the bottom that we had in oil in 2020. So, and this is all from Crescat Capital. I mean, it's publicly available. They put together a nice list that I copied just to, but central banks are buying gold, and frankly, what central banks own often are currencies and other currencies. But frankly, you talk about de-dollarization. I think that the balance sheets for virtually every country is shit, and I think gold is going to be attractive because it's going to be the only logical place for people to store. And certainly, if you don't like the U.S., like China or Russia, you're going to want to not own U.S. treasuries. You'd rather own gold. Another thing that really suggests that we're gaining momentum is here is a chart of ETF flows. In 2019 to 2020, you had a nice move in gold and went sideways. Now we're here, gold is moving up, and the flows are just starting. I think you could see over the next few months of doing well, but also over the next several years. Carter Worth's a friend of mine, and one of the things he told me is sometimes when you come up to a certain point, when if a stock is going to break out, you'll keep on hitting that point, and at some point you're going to break through it. Flip side's true on the downside, but that's not what we're concerned with. But right now you have gold. It is punching on that 2000 level. It went over it this week. I think it's going to continue. So I won the USA Today CNBC National Investment Challenge, run a couple of hedge funds, chartered financial analyst. I write on Seeking Alpha. I've been in the Journal, and that's all for me. And I'm gonna get out of.
So you're basically a rookie, is what you're saying, you know?
I started on the floor of the New York Futures Exchange, and yeah, well, actually, I'm 62, so I'm no longer a rookie.
Well seasoned. Thank you, Tyson. That was great. Cory, you want to, talk a little bit about what you're seeing right now in terms of where you're excited about investing. And then right after this, I want you to talk particularly about your fintech company. So Cory, why don't you go? And if you have slides to share, feel free to share your screen.
Yeah, sure. So we'll just run through a couple of quick slides, I guess. Presentation, where we go. Range view, slideshow. There we go. So, I like to talk in terms of reality. Reality checks and historical relevance, and everyone always at the top of every bubble, everyone says, well, it's different this time. And funnily enough, it never ends up being different this time. But looking at, I'm sure everyone has seen these yield curve charts ad nauseum. But this looking at the 10-year, 2-year, and this was a recent chart. I don't know exactly where this yield curve is before, but as we stand today, but looking at it, the yield curve inversions are the warning signal. They're not the trigger point. The reality is that when the yield curves turn around and go back positive, that's the real warning trigger of imminent recessions, as you see happens time and time again. But the relevance of where this yield curve inversion is today goes back to where we were in the 70s and 80s. And of course, that's when we had all massive inflations, extremely high Fed funds rates. And then, of course, as Tyson just said, we had decreasing Fed fund rates ever since then until we hit the recent bottoms, and now those are starting to turn. So this is that chart. So showing, but what's interesting on this, and maybe some of you have seen these charts before, but this is the rate hiking cycle. Of course, you can see this 20-year bond bull market or 40-year bond bull market as bonds ripped higher as rates went lower. But you'll see that the most recent rate hiking cycle, this has been the velocity of the rate hiking that has been occurring compared to the slow and mediocre rate rises from 16 to 18, or even running up into the 2006, 2007 bubble. We're talking about extremes like back in the late 70s and 80s. And so each and every time the Fed has gone on a rate hiking cycle, it has led to a drop, a crash, and or a crisis, including recessions and depressions. So looking at back in the 70s and early 80s, where was the federal debt as a percentage of actual gross domestic product and economic output in the country? We're sitting down in the 30s. Where are we today? We're up over 100%. We have more debt than economic growth. And so this is where it becomes extremely, creates an extremely different environment from where we've ever been before. And that's just the government debt. When you look at the total system leverage, so this is everything: government, corporate, household, margin, student loans, you name it, all the debt that's out there and has been forever increasing. Remember this right here in 2006 to 2009, this was the great financial crisis. This was what almost ended the entire global financial system. And now we've effectively doubled it from where we were before to where we are today. But this chart is comparing the debt to actual real gross domestic product. So remember what happened back in 1972. Speaking of gold, Tyson, we went off the gold reserve, backing the US currency with gold. And ever since then, the debt has been creeping up and then turning into this parabolic move, an expansion of debt. But think about this in real terms. If you take all of the debt out of the equation, then we have had no organic, total net positive economic growth since 1986. Everything, all the growth has been as a component of ever larger debt. So now when you add the higher interest rates and the movement moving forward, how the heck, to use a nice word, is the system expected to support all of this massive over-leveraged debt with higher and higher interest rates coming forward as we move down the road? So everyone out there in the markets keep talking about the Fed pivot, right? They keep saying that well, the Fed's going to pivot, and we've been that Pavlovian dog response to buy the dip, and the market's going to go higher forever because the Fed's going to be supportive. But the reality is, when you look at history once again, from the day that the Fed pivoted to the bottom of the market, the bear market that occurred, the majority of losses in bear markets occurred after the Fed pivoted and started cutting rates. Why? Because while they're raising rates, supposedly we're in a positive and beautiful economic growth environment. But when they start cutting rate, that's when the fecal matter hits the rotating object, and the economic outlook and earnings and everything else collapse, and so do market returns. The last three of them, 51, 58% after the Fed pivoted in 2007. So, think about where we are today. We're basically, they hiked today. We're basically going to be back to the rates we were at in 2007, but yet our debt construct is twice as big as what it was in 2007. Riddle me how this is all going to be sustainable. So one final thing, reality check, is taking a look at the money supply growth. Now, I looked at the current numbers through the end of March, and the money supply is growing at a negative 3.16%. Now, looking back historically, there's only been 4 times in history that money supply growth has been negative, and negative to this extent. And every single time, this has only happened 4 times in the last 150 years, and each time a depression with double-digit unemployment rates has followed. So, if you don't learn from history, you're doomed to repeat it, right? We all know that that adonym. So getting towards what we do. So, looking at your prototypical buy and hold approach, starting at $100,000, buy and hold, you have the dot-com bubble crash 2007 and the crash up to 2018, a 20-year period. Sure, there's some relevance to buying and holding and growing your portfolios, but when the next big crash that's already started hits, what does this value turn into? 1,200, 1.2 million, 800,000, 600, who knows? The difference with what we do with our active approach to investment management is if we can avoid the losses and think about full market cycles. If we can avoid the losses but get the growth, you can actually deliver the promised holy grail that Wall Street promises of compounding returns, because you're actually getting growth on top of growth on top of growth, as opposed to giving back all your wonderful gains each time the market crashes. So, just to give you a couple of examples and the guys, when we did our preliminary call for this, they wanted me to show a couple of things with the funds and the models that we run, but just a couple of examples. Our total return income fund, which is effectively half stocks, half fixed income. There are some rotations within there, but from 2017, when I left out of the broker-dealer world up till today, our conservative fund is up 16% versus the equal weight US market index, which is only up 2%. You'll notice the crash in 2018, the COVID crash, the massive run-up on $4 trillion from the federal government and $3 trillion from the central bank. If you remember the wonderful money printing, just pushing the print button on the money printing machine, but now everything's rolled over again. And you say, okay, that's a conservative fund. What about something that's more like for like? Okay, our aggressive 100% US equity fund, protected from the losses in 2018. Obviously, the orange line is our fund performance. Got growth protected from the COVID crash and then protected from the current downturn. In fact, we've made money while the markets have been pulling back. So, but this is just a topping pattern and process that we've been in. So wait for the real, the next shoe to drop as everything else comes down the pipeline. So Tyson was talking about gold. So yes, we do run alternative funds. We have a precious metals, a Bitcoin, a cannabis, and also commodities. But year to date, the precious metals fund is up 25%. And this is, the sales pitch that Wall Street would always say is like, wow, look at how well gold has done so far this year, even though, as Tyson already pointed out, we've really been in a sideways pattern since 2020. So the important part is not about what performance has already occurred. The important decision in when looking and analyzing investments is what is the future performance. You want to get in at the lows before the performance really kicks off, and that way you are actually attaining the performance, not missing what has already happened.
So I'm sorry, keep going.
Just that, and this is what done. So and Michael was talking about some of this with some adjustments, corrections, better entry levels, and so on. I mean, all this stuff really, when you break it down in layman's term, means losses. And so the anatomy of a bubble, you can look over this. I don't need to point it all out to yourself, but the smart money gets in early, the institutional investors, the public, the enthusiasm, the greed, the bull trap, and then the bottom drops out, capitulation and despair. And then this is where the smart money starts to deploy their capital after the drop has occurred, when there's blood in the streets, right? Where do we stand today? Well, it's pretty, funnily enough, the pattern of this recent performance is eerily similar to, the base underlying model of, bubble modality. So is this the next move that occurs as reality sets in? I guess only time will tell, but that's just like I said, a reality check on what's going on out there, and to sort of couch the conversation on where we stand today and where the opportunities are moving forward. Let's see, I got to stop sharing.
I think it's up top. It switches on you from the bottom to the top.
Yeah.
But, we could talk, because Marty had a question as you
go
were
ahead.
going through. And he said many people borrowed at low rates to avoid taxation on assets, equity sales, et cetera. Is there any money on the sidelines, as people say there is, or is the illiquid assets that have debt on top of them?
Yeah, let me close that down. I'm trying to get back to There we go. Screen sharing has stopped. Beautiful. Thank you.
There you go. Excellent.
You know, a lot of time now, what happened with my camera? So, you know, a lot of people talk about money on the sidelines and the massive amounts of money that are, you know, sitting in money market funds and everything out there. But you got to understand, especially in the stock market, it's a two-party system. You know, much unlike our political situation here in the US, which just seems to just be one party out there. But we won't get into that arena. But, you know, for every buyer, there's a seller. For every seller, there's a buyer. So there's always an exchange of whatever the underlying holdings are. So, yeah, they want to talk about money on the sidelines and how much it's grown. Well, look at the massive exponential expansion of money and printed out of thin air. And so the total value of the market is exponentially higher. So hence, even a small percentage of those assets in money market funds is going to be exponentially larger than where they were at the last bubble top. So, you know, when people talk about money on the sidelines, is it maybe it just depends on which asset class or which arena you're talking about, you know, as opposed to the stock market itself. But, you know, and sure, there's been a massive expansion, but now we're going, as we just saw with the money supply growth, we're going into a massive contraction. So
Fair enough.
from
Fair
there.
enough.
Very bullish on precious gold, commodities, very much in alignment with Tyson and his thoughts as far as where the future opportunities are.
Sounds great. And thank you for that. I want to toss it over to Ron here. Ron, I want you to talk a little bit about your company. Do you have slides to toss up there as
No,
well?
I'm going to write this minute. Just allow me to share.
Before we flip over to that, can I ask a couple of questions?
Sure, fire away.
Right, so I forgot a couple of parts. What I was very bullish on was, I think anything that's like cybersecurity or manufacturing reshoring is going to be doing well in the United States. I think there'll be government money and government public-private partnerships. Any thoughts on that, Tyson? Do you have any thoughts on that in terms of as an investment opportunity?
I'm sorry, on
NGOs.
You know, public
And
partnerships, defense spending, reshoring, manufacturing.
well, I think there's clearly a trend towards moving supply chains away from China called nearshoring or friendshoring. All that will be inflationary. And I think that that's a significant trend in terms of partnerships, publicly traded partnerships. I think that, you know, master limited partnerships investing in the oil and natural gas space are very compelling in terms of offering attractive yields.
So yeah, MLPs were pretty big back in the early 2000s. I guess you think that their pricing has come down?
Well, yeah, I think that you can build a portfolio of 8% and you can buy closed-end funds with 8 or 9% yields. And I think that the fact of the matter is, my case for commodities is certainly true in the fossil fuel area. There is just not enough capacity out there. And so the prices are going to remain robust, and people like cash flow and income. So yeah, I'm very keen on the oil and gas or energy infrastructure MLPs. But I would say that they've done very well off of the 2020 low. So they're now attractive. But I think that, you know, if Cory is right, I'm right. I think you want to be defensive. And a great way to be defensive is to own things with high yields, and high yields that are backed by actual hard assets. Because I think we're moving away from the paper asset inflation that we've seen that's been driven by declining interest rates.
So food for thought. I mean, we're in Los Angeles. Los Angeles is the mecca of aerospace. I mean, it's a tremendous, you know, Grumman, Hughes, et cetera. And I mean, I guess the question on reshoring and manufacturing, you know, do we think there's a positive outlook for those types of industries like space, other areas?
Absolutely. But I think perhaps we have a growing business in war. I mean, I hate what's happening in terms of the Ukraine. Everyone's talking about China moving into making a move on Taiwan. You're seeing what's happening in the Sudan right now. I mean, I think that we have a world which is it is like other inflationary periods, like the 1970s, where things are not looking good, and that's tremendous for defense manufacturing companies.
Right. I think that Yellen had a discussion or a speech the other day where she said that there are strategic industries, right? Whereas the real base of capitalism is let the best man win or let the best person win, right? So it's very counterintuitive.
But those are all dependent on what you think the dollar is worth.
Well, and this, it comes down to, the move from a unipolar world to a multipolar world. The dollar's moving towards, losing its world reserve currency status. You've got the contra or anti-SWIFT banking, the BRICS banks, and there's like 24 countries that have joined on there. That's supposed to kick off August 1st, but a weakening of the dollar benefiting international arena. So speaking about regionally, nearshoring, so to speak, then that could be a double benefit for places like Mexico, where with the dollar declining, which helps the emerging market countries, in general. But it's right across the border for close logistics for manufacturing such. But until and unless Mexico decides to go the route, I'm not sure. I don't think they're part of that BRICS consortium yet, but
They're not, but they're talking about going Bitcoin.
Right.
That's what they've announced, is they're moving towards Bitcoin right now. And they and El Salvador are getting together on that.
Yeah, so just so many different things going on in so many different parts of the world that any one of them could be a certain catalyst. But yeah, war is great for business.
This is an alpha panel, so let's talk about good investments. Yeah. Again, I think DARPA tripled their budget, and we actually had a healthcare company that received $80 million from DARPA. And so I think that, in some ways, some strategics can be seen even in healthcare for the US government, et cetera. So great. Ron Davari is going to be up next. But Ron, before you talk about your fantastic venture, can you give us a minute or two about real estate and our prior discussion about CRE and conversions, et cetera?
Yeah, my view is that if you're in real estate, you got to have a horizon, longer horizon. You're not in there to be short term. And with the amount of, I think, as you just said, nearshoring, with the amount of, even I would say hospitality versus commercial use, ESG versus non-ESG, there's going to be a huge amount of opportunity to put fresh capital into converting some of the old assets to the new. So as an alpha seeker, we certainly view that any sort of readjustment of the world, especially both the debt as well as the categories, it's a very target-rich area, but you need to be value add. You need to think about how do you take old assets and turn them into new ways of creating alpha. Although the office may be old, but we are seeing that there's quite a number of venues that are created for networking, not similar to WeWork or things like that. It's actually a lot more than that. We're seeing it in New York, we're seeing it in LA. People are just turning that into opportunities to blend, startups and other things within the confine of, that you can't not be there, right? Accelerators, things like that. And we're seeing that trend even happening as we speak. I'm flying to Bahrain to help a whole new accelerator that is going to be focusing on not MENA, but actually Saudi, Kuwaiti, Egypt, and CIS and Africa. Just regionalization that we were talking about. So you're seeing that people don't want to be just dependent on, and that has created real estate opportunities. That is going to be bringing people, bringing, a lot of, the stability in war, for example, situation. You're seeing Ukrainians and many Russians of certain caliber, they're just going to these places, and that creates opportunity even abroad. A lot of us are not looking outside of the United States, but that's where things are. Trying to buy real estate in Dubai today, I'll tell you, the prices have gone through the roof because everybody wants to use that as a storage of value, right? And you know, if you got cash and you don't want to leave it in the bank, where you put it. So as a result, I think both hospitality assets and even to some extent office space in those countries are actually on fire. So if you don't like what you're seeing, look somewhere else. And that's really what Alpha is about, right? Yeah, you know, you got to keep on searching, and I will get to that in a minute. So can I get to talk about where does Alpha and the fintech fit together?
Absolutely. Run through your presentation.
Right. So what is Alpha? We all know horizon risk tolerance,
Arthur?
liquidity, and liability profile.
Good. I was just typing I was going to send you a text, but I accidentally called you. So, but I just want to make sure I have your number so we can text if we need to.
Hey, Mark, you need to. Oh,
Okay, so what is Alpha, as I said? So this brings you to the world of what I consider, how do we match all these factors in a way that the investors can actually source the right transactions, the right deals, and so on and so forth. I believe about 80% of the assets are effectively either work in progress, or they are a factor, or they are trade finance, or essentially what's behind and underneath some of these banks, and perhaps you know, not really funded the right way. They're probably funded from from equity, as opposed to potentially a good solid debt that people want to have access to. I'll go over to another chart. So what we are seeing, the world, we're seeing through the you know, the angle of their employers, employees, merchants, consumers, and manufacturers, suppliers, processors and traders and growers, distributors and OMEs. And they're located in different regions around the world. And when you look at our current financial infrastructure with, as mentioned, SWIFT banks, and the banks that are being absolutely pressured to, when they don't know something, they essentially cut you off. So there are people who their funds get cut off for weeks. We were on a call with BMW trying to source goods in Turkey, and finding out that in order to get it, they need to get the money in the hands of the supplier because they had it. But in order for them to get it, they had to go through lots of hoops, and found out that lag was 4 or 5 days. And the goods will be stuck there, and the factory will not be able to function well. So if you look at those kind of blockages that are there, the best candidate to really be able to deal with that is ultimately going to be Web3. But the question is, how can you get the Web2? And these assets really don't truly belong in banks that have liquidity issues, they have transparency issues, they have confidence issues, they have run on the bank issues. And we have seen it, for example, in just the last 8 weeks or so, we have had more bank closures than we had in 2008. If the Fed was not as smart enough as they're today, we would have had a far more impact. You know, we just happened to have had that experience once before in 2008. So they managed to be able to insulate those to specific entities and frankly insulate the market. Otherwise, we would have had to close the market, the liquid markets in general. So the opportunities, I think, in private assets really comes down. I didn't even put in project finance. I didn't put in, you know, infrastructure that needs to be put in there, renewables. All that stuff nowadays are, in my view, financed in a very inefficient way and presented to the market in a very inefficient way. And if you look at some of the largest asset managers, they need larger deals. They need the due diligence timeframe is so large, and they're not going to be able to do that. So with that, I think roughly in 2019, before COVID, we decided that we want to go not where the hockey puck is, but where hockey puck is going. Unfortunately, we don't have a hockey puck, a hockey champion on this group, but one of our partners was actually he played actually on hockey team of Greece, of all places. He's Canadian. So with that vision, we said, we got to get the Web 2 right before we get the Web 3 correct. So there is no equivalent of even Web 2 for finance where BlackRock Solutions Aladdin was created, right? Aladdin essentially made it very easy that some of the banks that should have used those tools, they didn't, but the smarter ones have, including some of the largest institutions, use that to be able to look at their risk, whether it is essentially mismatch in duration, which is even a little kid, in first year finance would know you're not supposed to be doing that, but those type of things are not transparently conveyed to the marketplace. So we initially decided to step between employer and employer, and that's the earned wage access, and a step in between consumer and merchants on Web 2 with cardless and BIN-less credit cards, which can be settled with the merchant and instantly on the website, and be able to bypass FIS, Fiserv, and Visa and MasterCard. Why do you want to bypass some of those? Is because a lot of those tools are not internationally available, and also the kind of restriction that you have from a sponsoring bank to Visa to MasterCard to FIS. In order to get yourself approved as a financer, you have to spend at least 3 years of time, in which we have already spent to be able to put those infrastructures together. But we also needed to have a technology platform that put it together, do it not just for us, but make it as an embedded finance available to the marketplace. So that's Fin Plus Tech that was created that effectively take the data and not just use it in the dashboards that you've seen it, but put it in data lakes, and from data lakes to AIDI that could effectively validate and authenticate data, something that during the CCAR, I was not able to do for some of the largest banks. They had to completely revamp their entire system in order to be able to even validate the data. The risk, the front desk, the back office, the payment system had totally different data and different models. So with that in mind, I think we put the first leg of this, which is the Web 2 solutions, and that's under NewOak Finance, and that is financed so far by two very visionary funds out of Canada. There's a debt and there's an equity fund that we have provided. And from day one, we made that democratized. So actually these two funds, even though they're alternative, they're available to Canadian savers, meaning that they can put it in their saving plan, provided that they're meeting a certain category, and those channels are available through our Whitehaven platform that does the due diligence and a very solid way of compliance to go through that. So with that really in place and all launched, we decided that we were going to go through the next leg, which is the Web 3 version of that. And we have, I'm pleased to announce, and you guys are going to be the first to hear that, we have now teamed up with the only government-backed level 0 and level 1 blockchain out of the Abu Dhabi global markets, and that's Venom Foundation, which is actually happened to be headed by another BlackRock veteran. And then we have signed effectively a joint venture with them to be able to transfer this technology in a way that, I'm going to go back, that would be able to instantly, and very importantly, instantly connect any end-to-end transactions as long as they're validated. It's not decentralized. I want to highlight, it's actually centralized. It's actually, they're centralized in a way that each component of it would be fully validated and fully authorized and complied with in every country. And the data and validators are generally those channels, but your accessibility to those assets become a lot easier because the due diligence timeframe is already done, because you don't have to do due diligence for 10, 20, 30 potential investors. All of that is already pre-staged and validated and effectively reps and warranted in that channel. So you've seen that. You've seen quite a number of digital distribution platforms that have been announced, but they don't go deep enough. They don't go into the finance area. They
Ron,
go into
on the interest
Yeah,
of
go ahead.
times, we've got to sort of cut short here.
No,
So-
definitely. I just want to thank you for letting me explain it, but essentially what we are trying to do is we are really inning one, and we have a lot more innings to go. But we do believe that the world needs that connectivity on a Web3, and Web3 is here to stay. Not only here to stay, but replace Web2.